Hello and welcome back to the channel, your go-to source for understanding the complex world of hard-to-borrow stocks and potential short squeeze setups. Today, we're diving deep into a fascinating name that's landed on our hard-to-borrow screener with an absolutely eye-watering cost-to-borrow fee, ZCMD, or Joncho Inc. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what exactly is Joncho Inc., ZCMD? Show ZCMD logo/chart. This company operates in the healthcare/health information services sector, specifically in the People's Republic of China. Under their endemic brand, ZCMD provides crucial healthcare information, education, and training services to medical professionals. They even offer patient management services and have a segment for the sales of patented drugs. With a market cap of just $5.07 million, ZCMD is firmly in microcap territory. Looking at recent price action, ZCMD has seen some significant downward pressure. Today is down -1.16%, over the last 5 days it's dropped -9.9%, and in the last 30 days, we've seen a steep -46.62% decline. What is cost to borrow and why it matters? Now, let's talk about what makes ZCMD unique on our screener, its cost to borrow. For those new to short selling, when you want to bet against a stock, you need to borrow shares from a broker, sell them, and then buy them back later, hopefully at a lower price. Brokers charge a fee for this loan, known as the cost to borrow or CTB. This fee is typically expressed as an annualized percentage of the stock's value. When the CTB fee is high, it tells us a few things: either there's very high demand to short the stock, or the supply of shares available to borrow is extremely limited, or both. Why does it matter? Because these fees directly cut into a short seller's profits and can make holding a short position very expensive and risky. These can easily exceed 100% annualized, meaning holding the short for a full year would cost more than the stock's entire value. Why this stock is hard to borrow right now? For ZCMD, the numbers are astonishing. Its current annualized cost to borrow fee is a staggering 846.6%. Highlight CTB number. This is an exceptionally high number, signaling immense pressure on the borrowable shares. ZCMD also has a very small estimated float of just 1.1 million shares. A small float means there are fewer shares readily available for trading, and critically, fewer shares available to short. When you combine an incredibly high cost to borrow with a tiny float, it creates the perfect conditions for a stock to be categorized as hard to borrow. While the exact number of shares currently available to borrow is unknown, this sky-high CTB strongly suggests extreme scarcity. Now, it's crucial to understand that a high cost to borrow does not guarantee a short squeeze. It can also indicate that short sellers have very strong conviction in their bearish thesis and are willing to pay a premium to maintain their positions. Squeeze mechanics explained. So, what is a short squeeze and how does ZCMD's setup relate? A short squeeze occurs when a stock's price starts to rise, forcing short sellers, who had bet on a price decline, to buy back shares to close their positions and limit their losses. This buying action then pushes the price even higher, creating a snowball effect as more shorts are forced to cover. The higher the cost to borrow, the more pressure short sellers face, as those daily fees eat away at their capital. A small float, like ZCMD's 1.1 million shares, can make this effect even more dramatic because there are fewer shares for short sellers to buy back, intensifying the demand and driving prices up even faster if a squeeze begins. Dilution risk check. Before getting too excited about squeeze potential, we always run a dilution risk check. Dilution happens when a company issues new shares, which increases the total share count and can reduce the value of existing shares. Even with a high cost to borrow, significant dilution can completely offset or negate any short squeeze thesis. The good news for ZCMD is that our checks found no recent dilutive SEC filings such as -1's, -3's, or 424Bs within the last 90 days. This means there's no immediate overhang of newly issued shares that could flood the market. Recent reverse split watch. Another important factor for ZCMD is its recent reverse stock split. ZCMD executed a 1-4-3 reverse split just 56 days ago, on June 29, 2026. A reverse split reduces the total number of outstanding shares and, consequently, reduces the float, which in ZCMD's case is now 1.1 million shares. It also resets the share price higher proportionally. Historically, we've observed that many microcap stocks tend to see renewed volatility or even a price pop within about a month after a reverse split, though this is a pattern we've seen, not a guaranteed outcome. While ZCMD is slightly past the typical 1-month window, the reduced flow from the split continues to contribute to its hard-to-borrow status and potential for volatility. Again, a quick reminder. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should you be watching for with ZCMD? A potential short squeeze would typically require a significant increase in trading volume. Today's volume for ZCMD was only 270,999 shares, which is dramatically lower than its 30-day average volume of 8,379,763 shares. This translates to a relative volume of 0x average, meaning current interest is extremely low compared to its typical activity. For any significant upward price action or squeeze, we would expect to see volume pick up dramatically along with consistent positive price momentum. You'd also want to monitor the supply of shares available to borrow. If it continues to shrink, that adds more pressure. ZCMD presents a compelling educational case study with its exceptionally high 846.6% cost to borrow and small 1.1 million share float. The absence of recent dilution and the impact of its recent reverse split certainly add layers to its current market dynamics. However, remember that high CTB alone doesn't guarantee a squeeze and current volume is very low. Always exercise extreme caution and conduct thorough due diligence. If you found this breakdown of ZCMD helpful, please hit that like button, subscribe for more in-depth stock analysis, and let us know your thoughts or any questions in the comments below. We love hearing from you.